Hi, and welcome to the second season of the Flow podcast, where we discuss institutional market structure with industry leaders. And today I'm really glad to have Mike Holstein, the co-founder and Chief Revenue Officer of Coinroutes.
Yeah, hey
Mike,
Konstantin. Really good to see you, buddy.
it's a pleasure having you here. So let's start with just giving some context and explaining to the audience what Coinroutes is.
Yeah, I had basically partnered with two gentlemen that I had worked with prior, David at Citi and Ian, his son, back in 2017. Really, we wanted to bring to the market a lot of the benefits that we had brought to market with other products like Lava Trading was another product that I had brought to market back in 2001 for equities. I worked with Virtu Financial and ITG where we brought Triton to market, provided that to asset managers. These are ways to tie together exchanges, tie together market makers, liquidity providers, overlay algorithms like algorithmic market access. So people, are typically in traditional finance are used to hitting a VWAP. That's how they think about meeting a benchmark on a trade. We use TWAP a lot, or volume weighted participation, things like that. So these, and then plugging in, workflow tools and things like that around, accounting and settlement and portfolio management and risk and things like that. So those are really important tools that, I had grown up on trading floors, throughout the 90s and the 2000s using things like Fidessa and Brass and, a variety of other products. Bloomberg has, a variety of OMS products, FlexTrade, FXall, things like that. So we wanted to be able to bring those toolkits to crypto to really kind of enhance the experience that maybe some traditional finance managers and portfolio managers would expect,
Exactly. And in very brief terms, what are the key value adds that you guys bring on the table?
Yeah, being able to trade liquidity so that you don't cause a significant amount of impact when you're trading something that's either thin or you're doing a huge amount of. These are really important factors especially for managers that are turning it over. Is that their alpha is significantly impacted by the costs of trading, and it can literally make a fund go out of business or lose its LPs. I mean, it literally is the difference between making it work and not making it work. So these are incredibly important tools, and banks offer these things in traditional assets. Like you go to Morgan Stanley, you go to Goldman Sachs, you go to Deutsche, you go to Bank of America, you go to your partners on the sell side to provide you these tools because they're expensive and they're hard to build well, and it takes a lot of expertise. So all traditional asset managers, whether it's Vanguard or T. Rowe or BlackRock or whomever, they go to the sell side for these tools. So we wanted to be able to provide a similar experience,
Of course, and I think that's definitely quite a challenge in the digital asset space, which is way more fragmented comparing to any other asset classes that you've just mentioned.
We're not afraid of fragmentation, Konstantin.
Exactly.
Fragmentation is literally one of the reasons for us to be in this business, right?
Exactly.
It's like if you go back to when I helped launch Lava back in 2001, which was a successful smart order router, first smart order router in the category. It was in stocks, equities, which we ended up exiting to Citigroup. They still use the technology, by the way, but you looked at the explosion that was going on at the time of they call them ECNs, they're like exchanges, and they call them dark pools, in equities. But there's 50 potentially dark pools and exchanges that you need to, and every week it seemed like there was an announcement of a new one because entrepreneurs want to bring new things to market and they want to try to build a successful product in their own brand. And there's in the ecosystem, there's symbiosis where these exchanges can find liquidity, which can be useful for a sell side desk or a manager, buy side, but it's almost impossible for these managers to get to those exchanges. So those exchanges need systems that do connectivity to provide that, and those managers need the liquidity to get their execution done. And so there is a place in the ecosystem for what they call us these infrastructure players, to provide all the technology and the know-how and bring our quantitative analysis. I was at Virtu. We had been at prior, Two Sigma, some of our other team members, and so bring that signal building quantitative analysis in, to help with the execution quality along with just access,
Yeah, and basically that's why they need Coinroutes. So we just briefly touched Coinroutes. Let's then talk about yourself. So you joined Coinroutes in 2018, right? It's been like 7 years already. I think in crypto years, that's like almost 15 already.
Thanks for reminding me.
Of course. And you've been like with JP Morgan, you've been with Virtu, like you've been on the market for quite some time. What really did drive yourself personally to pivot into the digital asset space?
Yeah, I had really made a career out of providing infrastructure and being involved with banks that were trading on trading desks. So like I started my career trading on the Bank of America trading desk and providing technology support for, a variety of like trading products and exchanges. And I went to JP Morgan, I went to Citigroup, I went to Virtu. And I wanted to be able to do. I got excited about crypto pretty much in 2016. I was doing a lot of trading on the side when I was still at Virtu.
Just for the personal account?
Just in my personal account. Actually, my first account was with Poloniex. And I'd literally heard about it on CNBC, and I Googled it, and then I ended up just opening an account, and I was just trading whatever shit coins, were available at that time, and just sort of getting to know, what getting deep, and then once you go down the rabbit hole, I became kind of a Bitcoin maxi and then an ETH maxi. It seemed very natural to look at that landscape and say, there's a lot of exchanges here. They're going to have fragmentation. If a traditional asset manager wants to come in here, he's going to need tools. This is something we could actually help. Sure. Yeah, we could make a real business of it and make some money, but we could actually, build something here of value, because, that's really ultimately, like, if you want to build a successful business, it needs to be of value to, your customers, your employees, and other market participants, like Finery, like, people need to find you valuable and want to put the effort in to connect and do the work, because everybody is resource constrained, right? Exactly. And they have to prioritize the venues.
And you've been working with large banks. I guess you definitely know how hard it is to build something in-house, and you definitely need a reliable vendor or a partner to just get out on the market.
Yeah, one of the biggest issues with an exchange, and probably similar to you, is getting a client to A, do the onboarding and the KYC and get that completed, and then B, prioritize the API certification and get through that. And that is a big challenge for no matter how big the exchange is to consider, and so why do big market makers and other participants connect their APIs? Because there's liquidity, right? Because
and there's no fix, at least for the crypto native exchanges, right? When like we're used to the fix protocol in the traditional space. In crypto, like every single exchange has its own WebSocket or REST API, and I guess it just adds another layer of complexity that no one from the traditional space could have imagined.
Yeah, exactly. We have a fix normalization layer with WebSockets. So we'll absolutely certify with fix, and we kind of like standardize our API for a variety of fix engines that are popular, FixFlyer, things like that. But one of the services that we provide, obviously, is we're going to connect to, right now I think we have like 50 venues that we connect to literally, and we're connecting to them over REST, WebSocket, and Fix. Because the other thing that you find is that, we're somewhat nascent in this industry. The way I actually remember, I'm old enough to remember, this is true, like NYSE going down every other day, like NASDAQ literally having an outage, like, oh, symbols A through F on the NASDAQ are down right now, right? That probably
I remember like the Facebook IPO.
You remember that?
Yeah, I do remember that. It was delayed for like a couple of hours. Or?
Oh, and then a whole day. They literally blew it up. They pushed it to their secondary IPO system, and then they ended up literally crashing, and then instead of opening, it opened at 32 and traded down to 18, right? So like these things matter. They impact the market, and they impact companies and corporates' decisions on where to list and when to list and how to list. And these make enormous have a ripple effect into the industry. So, being able, for us at least, we look at connectivity. We don't just connect to a venue if they offer fix over fix. We'll connect to their REST and their WebSocket, and then we'll look at the connectivity. And sometimes what you'll find is, that you connect to different load balancers, and so they could, that Binance could be having an issue right now with WebSocket, but we also we can ping them on REST. We can look and listen on the fix connection to see if your order got any fills. These are really big differentiated services for you to actually know is my order filled or not, when the markets
Exactly.
are moving really quick, and being able to be nimble and make those decisions and not later having to go back and find out there was a break or something like that, can be really, those are some of the biggest errors that we see clients take in the industry is they thought they were long or short something and they weren't.
Yeah, oh yeah, I think that's a huge pain point, especially with the fragmentation. But yeah, you guys efficiently solve that. And what are the other lessons, or what are the other best practices that you have taken from the traditional space and brought it into the digital assets?
Yeah, I think, redundancy is super critical. Like having fully redundant systems that are battle tested. We've been doing this it's like our 8th year, right? We've been connecting to exchanges and liquidity providers now. Um, we've we have executed since our inception almost $1 trillion of value in trades, and that's broken up. If you think about the average trade size,
Yep.
is probably several hundred or $1,000, depending on if it's a perp or if it's derivative or spot. So you're literally talking about billions of observations of orders that we've sent. Most of the orders that we send to exchanges don't get filled by design, right? Because we're hunting for a good price. It's liquidity seeking,
Of
right?
course.
And our signal is determining where we think where the algorithm thinks it's likely to get filled. Most of our competitors, and we've talked to all of them about this, are sending your order what they call pegging, right? It's like pegged to the bid. And what you're effectively doing when you're pegging something to the bid is you're saying, I'm giving up agency over what I think the value of this is and what the fill probability is, and I'm giving it to whoever's on the bid. And that person on the bid could be some kid in his, like dorm room putting in a $600 order, right? That is had no idea that he's about to get run over, and whereas if you had looked statistically, if you'd looked at the order books and you had looked at like the book pressure and some of the other more consistent signals that are pretty correlated to future returns, you would have known that there was a high likelihood that the price is going to be lower,
of course,
in like 15 seconds or something. It's hard to predict much farther out, I think, than what we've noticed in our observations to 15 or 20 seconds, but that is absolutely enough time to get out of the way of a steamroller, and most of our clients are picking up nickels and dimes in front of a steamroller. We can get into it, but like some of the more popular strategies are yield bearing, sort of like low risk, delta neutral strategies. And those are effectively where, people like investors love the idea of harvesting nickels all day long and having really good Sharpe ratios. Some of the things that are a little bit out of, because of the current market conditions that are just a little bit out of vogue are discretionary strategies where, you could, there's a lot of discretionary funds that are down from 24. And, we hear about that a lot, we obviously, so what we've been able to do is help build, delta neutral strategies that are spreaders and multi-instrument, multi-legged trades, multi-venue, obviously, and take advantage of things.
The majority of your customers are on the buy side, right? So it's how is your clientele distributed?
It's a good question. I really look at it as we seem to have differentiated ourselves. If you look at the segmentation of who our customers are, at folks that actually really care about the price and about the outcome of their trade. So what does that mean? Like, well, proprietary traders have the most to gain because they keep 100% of profits and they eat 100% of losses. And they also tend to be need to be careful with their credit and their collateral because they only have so much assets, and the more assets they can put to work, the more profit that they can make. And they also maybe are, they're paying fees on leverage and lending. So if they have to lever up, they have to be extra right, and extra careful. And so most of our clients are, pretty careful in nature around wanting to ensure that they're making profit on trades and that they're optimizing their alpha and they're not really leaving anything on the table. And as you know, venues, exchanges charge maker taker fees. And so that can be the breaking point, between profitable and not profitable trades. And, look, people who want to trade with liquidity providers and OTC desks and all that, it's really advantageous to trade with them at a good time. If you're looking at correlated signals into the market as to what the price is likely to be lower on an exchange in the very near future, well, why would I buy it right now from Wintermute or Galaxy or Falcon or somebody like that, right? Why wouldn't I just wait 10 seconds and see if the highly correlated signal was right? The risk reward on that is pretty skewed to waiting. And so those are value props I think that we can bring to clients and that they really can appreciate. And it's hard to dissect every individual trade, especially when we're breaking up your order into thousands of pieces, right? And decide if, was this a good idea? Did this work out? Anecdotally, traders, are very tuned in, and they tend to know or feel that this was a really good idea. But we also obviously have a really robust service on transaction cost analysis, which is where we're looking at your average price of your order executed versus VWAP versus the arrival price versus a variety of benchmarks and different ways of doing benchmarking. This is something you had asked earlier that we had taken from traditional assets.
Exactly.
This was something that when I was at ITG, we owned like 50% of the market in this type of product, and it's very well received by some clients who are really penny pinchers, and it's other clients don't really look at it very carefully because oftentimes they're so big and they're whipping it around and they're making so much profit on things and they're making money in other ways. Like, I don't always see our system, a trader, a venue like an exchange doesn't always see how a client is making money on that trade. That might be a hedge that they're doing. They might be making money on an options trade on the other side of that. They might be shorting futures on the other side. They might be earning, a funding rate on the other side of that. They might be lending that out to someone. They might be getting staking revenue. It might be a treasury trade. There's a lot of things that no venue actually knows why the client is trading it at the moment. It could very well be a discretionary trade and they think it's going to go up, right? I mean, but yeah.
But you guys have higher chances of knowing and seeing both legs because you cover, as you mentioned, 80 different venues and liquidity providers.
Yeah, 50. Yeah, exactly. That's our business, right? Is providing these both legs, multi-legged of the trade. And what we're seeing a lot of, one of the really cool, and we were talking about this in terms of how it works for Finery, is one of the really cool things I think that's emerging right now is we're getting a lot of traditional managers, brokers who are coming into the space and they want to put on trades that are spread between the CME on one side with regulated products. I know the SIBO wants to bring regulated products that I saw today. Kraken bought, Ninja Trader, right? So there's more and more regulated derivative products that are going to be coming to market, which is great because more competition, the better. And CME is bringing out more new products, like a perp lookalike product that we could talk about later. And there's a lot of interest in being able to face off against spot and perpetual swaps and leveraged futures that are on foreign exchanges, whether that's an exchange or whether that's through an OTC desk, and where you're helping create that sort of that wrapper to be able to make a rate for a client that's sort of like a white label rate.
Exactly.
And then they can hedge against that. And there is a lot of demand, I think, for these delta neutral trades that can generate revenue in multiple ways, basis and funding rate arb and all these different things, taking risk off the table, advantaging players that are sitting in cash and can cash settle and taking advantage of better prices there. These are, I think, a big growth area in the market as we expand into what we're hoping, because of what the current administration is bringing. Regulatory clarity is more traditional players. I think we're going to see an explosion in these type of multi-legged, lower risk yield trades that are sort of delta neutral.
And how would you see the distribution of the spot versus perps or CFDs or NDFs trading right now and within the next 12 to 24 months?
Yeah, it's a great question because it comes down to where you're regulated and where your jurisdiction is and what your existing business looks like where you want.
Let's talk about the worldwide trading activity. I mean, not specific to the US, but in general,
we're seeing a lot of hedging interest on emergent perpetual swap and futures markets that look like Obviously Binance is a leader in this.
Yeah.
OKEx, Bybit, Deribit are leaders and have been for a long time, but we're seeing emerging interest in hyperliquid, these perp dexes, like DYDX, Gravity, GMX, Vertex. We carry these venues. There's emergent interest there. There's also other tiered, Coinbase International has these products. Bullish has these products. There's a lot of regulated exchanges that are coming to market that are carrying these products. KuCoin wants, to advance.
Yeah, well, Kraken's like CF benchmarks or like
Kraken has Kraken futures, and with what they just bought, they're clearly making a signal that we want to be in the derivatives market. They are seeing what I am talking about, which is we've been seeing forever. I mean, why do we do 75% of the volume that we do? We did 30 billion or so in the last few months, a month, right? So we're doing about $1 billion a day on behalf of clients with a variety of venues, and the majority of that is in derivatives, right? Perpetual swaps and futures.
So you think the share of derivatives will only be growing, right? Going like within the next 12 to 24 months, or do you see spot will be actually growing faster?
Yeah, it's a great question, and if you have to divide spot up into categories to think about how, because Bitcoin's obviously going to be treated very differently as a spot instrument than foundation tokens and alts. If you want to have a hot market for a new alt, like if you're a foundation and you're bringing your coin to market, the best thing that you can do in addition to listing it at the right venue is getting a perpetual swap out so that there can be liquidity that folks can hedge. And that's part of our job, and I think our clients' jobs that do broking in foundation tokens is to explain the value of having robust markets, even though that means that folks can sell or short potentially the perp in these markets. Why, the best practice has always been, and I've seen this in the market since I started, is that having shorting in a market is healthy, and it allows the right participants to be able to come in, express their interest, and pay, for the benefit of doing that, right? They're paying margin, they're paying fees, they're looking at the open interest. There are fees to taking hedges that, we as participants in the market, are that's how we kind of earn, that's how we should be earning our bread and butter, and keeping fees low for exchanges so you can promote more transactions. One of the things that you see when you look at traditional markets over time, as costs come down, performance costs come down, impact costs come down,
the volumes
go up. Crank.
Exactly.
And so that's what we want, right, for this market, is to look just like the derivatives markets and the equities markets and the option markets and all the major markets, FX markets over time, is we want to see fees come down and volumes go up, and we want to see it easier for more participants to come in and make trades and not, impact, and have a bad experience in the market. And so, that's a lot of value I think that we can bring collectively.
That's exactly what we're doing. And let's zoom out just for a second and let's talk about the market structure. Like, crypto is the most dynamic, I would say, asset classes in the space. And what are the top 2, top 3 observations over the last 5 to 7 years of like what are the particular changes in the crypto market structure that excites you the most?
Yeah, no, that's a good question. I wish I'd prepared for this. No, it's like the cost, the impact. If you were looking 5 to 7 years ago at a chart for Bitcoin during the day, you would have seen a significant amount of volatility just in the squiggle lines, for intra-minute volatility. You would have seen prices going up and prices going down. The intraday volatility has dropped so dramatically. And the question is, why? What was causing prices to leap around like that? And it was the problem of the price discovery. It was the invisibility of price discovery. What would happen is 5 to 7 years ago, the dominant way that you would trade a block of Bitcoin, if you had a big seller come to market and say, I want to sell, $100 million worth of Bitcoin or $50 million of Bitcoin, some big number. What they would do is even lower numbers, they would call around, literally like get on Telegram, right?
Yeah.
And you would hit up all the major players, B2 and Laser and Galaxy and Falcon and all those, all the major players. And you'd say like, I've got, 50 million to sell,
Yeah.
which by the way, like we don't do that anymore in equities and FX. Like we have RFQ products that just say, like,
Two-sided.
I have 50 million, give me a two-sided quote. Maybe the smarter traders would say, okay, what would you do for me two-sided, right? Maybe, but it certainly didn't look like that when you looked at the chart, because what you would see is for like market makers that didn't win the deal, going out and buying it,
Of course.
right, ahead of what they knew was going to be, tremendous pressure.
That's like in the fixed income rate right now. Like the second best quote wins in terms of the pricing, the P&L on the trading desk, not the one who actually took the hit. And it's actually quite funny because you mentioned that when we were looking at the space, right, and analyzing like out of queue specs of some of the tier one liquidity providers. I won't mention any names here, but most of them, they don't even have an API call for a two-sided quote. Like literally in the current space, it's kind of a general practice if you're only doing a one-sided RFQ, which is nonsense in the traditional space. But that's what the markets are, and that's slowly changing. But yeah, so that's like you mentioned two things, right? The intraday volatility that's definitely changing, right? The change of some of those best practices of like introducing, I would say some of those practices from there's a global FX code and FX, which defines most of those use cases. And anything else that you want to highlight?
Well, one of the big differences that we see, if we look back at 5 to 7 years ago in terms of what we traded, we were trading only spot tokens. There just wasn't a lot of liquidity yet in crypto derivatives. And when you now were people trading on leverage? Of course they were. But you saw what happened when lenders were providing, they were making, uncollateralized loans effectively. Like if you consider FTT collateral, that's uncollateralized really. And we had a major problem in the market, right? When all that blew up and the FTX happened, that was a major black eye for our industry and was really set us all back years. And so what needed to happen
Well,
was,
not all of us. I mean, Finery Markets was the main beneficiary of that, right?
Good for you, man. That's great.
I mean, like short term, the impact for the entire industry was just horrible. But I think that did help for most of the institutions to actually have this mental debundling of the risk and basically trying to split the custody from the brokerage, from the exchange and the market making sides. So I think that's something that needed to happen and that really helped to emerge the space.
Well, I can say this, like, I hope it was our Lehman moment collectively, because, I was, active in the markets and I was at Citi in 08, 09 during the GFC. And, the Lehman moment sort of like changed forever the way that traditional asset managers think about counterparty risk, right? And they have
Knight Capital, MF Global, I mean, all of those guys, like these were my primary brokers back in the day. So
yeah. We FCM'd when I was at ITG through MF Global. So like that was a bad surprise.
Oh yeah.
I think the point is that what we're seeing emerge differently is that there's a significant amount of like lending capital, which looks like margin and it looks like leverage and on perps from the exchanges. And the exchanges are by far the biggest counterparties of lending and leverage in the balance sheet in the market, in the crypto markets today. Like if you look at how much OKEx and Bybit and Binance lend on a daily basis collectively, it's probably more than the entire market put together. In terms of like when you're looking at like actual crypto transactions, right? And that's different, and so along with that, you're seeing a lot of, consumer, professional, and institutional interest among perpetual swaps and other instruments where they can actually derive some type of margin. In equities, we have a 50% margin provided, via FRB on equities that you can take from your broker, and your broker is going to have whatever broker, clearing broker provide balance sheet for that, we probably should get something similar.
Yep.
If these things get classified as securities, and I think that'll be interesting. Right now, you will remember, I'm sure, when Coinbase and Kraken tried to have a spot margin product,
Yeah.
and they got run over by the last administration's SEC. And so they pulled back from that. I think that'll be really interesting to see if that can emerge. I think that, there's a lot of Robinhood type of traders that would love to be able to whip around on margin, and I think that'd be really good for spot, because you were kind of asking me about, how do I see the emergence of different instruments? Is it going to be a spot play? Is it going to be a derivative play going forward? If we can get some type of leverage and margin products that are allowed.
Yep.
And then, this is sec lending is one of the most revenue intensive areas for banks and primes to be able to earn money. So I'm sure they're very interested in this for their crypto clients. Conversely, if we can go down the rabbit hole of getting perpetual swaps approved here by the CFTC, I think then we can get all kinds of great leverage through those types of instruments. And then we're going to see an explosion of those types of instruments via traditional exchanges, like CBOE and like CME, which is why I think we saw Kraken take a $1.5 billion stab into that market today. They're clearly planting, their bets. They're placing their bets, right?
Yeah, I think there will be a massive M&A cycle for all of the TradFi and large crypto native players actually trying to merge and acquire each other. So it will be interesting to see. I have last couple of questions. So we just mentioned regulation. And what are the other barriers that you think right now are there so that needs to be ticked in order to allow a massive institutional adoption of digital assets?
I mean, I think the good news is we heard Trump talk today, at the conference, specifically about what he's trying to do. He wants Congress to pass legislation on stables. That's his first thing. And I think that's incredible, because if the banks get, the whole idea of on-ramp, off-ramp, and, that is their primary, one of, SWIFT and the transfer of assets and all that, and then custody of assets on both sides of those transactions are one of the primary ways that banks provide value and generate revenue and, and being able to hold overnight interest rates and all that. So I think that would be great. The banks are going to get stables, and every bank's going to want their own branded stable. So we spent some time in Dubai. As you know, we have an operation there, and met with some of the folks that work through I won't say which, but one of the major banks. And they are white labeling a stable token through a US stable token company. I can say who it is. It's the Benji token through Franklin Templeton. And they're going to make a dirham pegged stable token that their bank will then use to promote transactions and do fiat on off-ramp and on-ramp. And that is probably a very easy use case to extrapolate to every company, every country, and every bank globally. Right? Why wouldn't you, if you're a bank, want to facilitate more transactions and more money coming in, to your bank, more assets on balance sheet, all the reasons that they're there, better interest, more interest, overnight interest that they can float, all the reasons to be a bank. So I would suspect that if Congress can wrap their head around this, and I don't see how the Republican administration can't, because for US stable tokens, you're literally depositing dollars. You're buying dollars.
US government, I guess, is probably the main beneficiary of everything that's happening in the crypto, because every crypto exchange using stablecoins as a benchmark, right? No one knows how much Bitcoin is worth in euros or even in pounds. Everyone knows the price of a Bitcoin in US dollar. And in order to actually trade that, you need to have a US dollar stablecoin. So I think US is pretty much positioned to gain from every country in the world adopting the stable coins locally. So yeah, it's exciting times. 100%. All right. So my last question to you is, what is a Bitcoin, Michael?
I think for me, Bitcoin is sort of the leading edge of a use case of what can you do with this cool blockchain that we have, and so people get the idea of digital gold. They get the idea of like, hopefully like more uncorrelated, custody of assets, and things that are portable. And like, this is something that like collectively worked as the first real use case, right? Like whether it was, foreign nationals that were in countries with restricted currencies that sort of needed to get assets, sort of out of the border, to protect them. That worked, like you look around at what we thought worked. Satoshi thought it was going to be a payment vehicle, right? He thought it was going to be Venmo or PayPal. Well, it wasn't. Turns out we have PayPal. Turns out we have Cash App. Turns out we have Venmo. As Americans, like, it works awesome. I send money to my family and friends all the time, every day. I don't send them Bitcoin every day, right? So like that has emerged as the primary use case. And I'm happy for that because, what we can do with smart contracts on the blockchain and everything is exciting. But you always need a killer app in everything, every invention through time, the internet, everything. Like we know what the first killer apps were for the internet, right? It's not always the most savory thing, but eventually, like, B2B and commerce, took hold. We went from Web 1 as like basically a Yellow Pages as a phone book to Web 2, which is, real commerce, for businesses and consumers to be able to make online transactions and things. And so like, Web 3 is exciting, right? Like what all the things, the promise of what we can do there. So that's, for me, what I love about Bitcoin is it's globally and universally accepted with a real use case, and it's, I think, here to stay for that.
No, I think it's a great answer, and we're all pretty much aligned on that. And thanks a lot for being with me today. I think our users and listeners enjoy that. Thank you.
Thanks, Konstantin.
Thank you, Michael.